ETFs are dominating the watch lists of dividend investors right now, and they represent two fundamentally different investment philosophies. On one side, we have SCHD, the Schwab U.S. Dividend Equity ETF, a steady, long-term wealth builder that prioritizes quality and dividend growth. On the other side is JEPQ, the J.P. Morgan Nasdaq Equity Premium Income ETF, an income machine delivering sky-high monthly yields through an active cover. Call strategy. Choosing between these two could shape your financial future in a big way. One is built for compounding wealth over decades. The other is built to generate serious income right now. But here's the dilemma. You can't have both strategies fully in one fund. Your decision will ultimately come down to your financial goals, your timeline, and your risk tolerance. In this script, we'll break down 5 key categories to determine which ETF deserves a spot in your portfolio: investment strategy, diversification, dividend income, risk and cost, and tax efficiency. By the end, you'll know exactly which fund aligns with your goals. Category 1, investment strategy. Let's start with SCHD. This ETF is a textbook example of high-quality dividend investing. It tracks the Dow Jones U.S. Dividend 100 Index and has a stringent screening process. Every company in SCHD must have paid dividends consistently for at least 10 years. That means these businesses made it through multiple recessions, financial crises, and market drawdowns while still rewarding shareholders. Beyond just paying dividends, the companies in SCHD are evaluated on multiple metrics, including 5-year dividend growth, return on equity, and cash flow. SCHD also enforces a 4% cap on any single holding and a 25% cap per sector to avoid concentration risk. The result is a diversified group of 100-plus blue-chip U.S. companies. Think Coca-Cola, Texas Instruments, Home Depot, Cisco, and Verizon. Now, JEPQ is a very different animal. It's actively managed and uses a covered call strategy to generate high monthly income. JEPQ holds large-cap Nasdaq stocks like Microsoft, Apple, Amazon, and Nvidia. But unlike SCHD, which is purely buy and hold, JEPQ overlays an options strategy by selling call options on its holdings to generate premiums. This is like owning rental properties and also renting out your rooftops for solar panels. You keep the base income, but sell off the upside. The trade-off? You limit capital appreciation, but gain consistent income in return. Bottom line, SCHD is for growth-minded, long-term investors seeking compounding dividend wealth. JEPQ is for income-focused investors who need consistent cash flow now. Category 2, diversification. SCHD takes a broad approach. Its 103 holdings are spread across sectors: consumer staples, financials, industrials, healthcare, energy, and tech. The fund rebalances annually, adjusting for market shifts. For instance, in March 2025, it dropped 17 stocks and added 20, increasing its energy exposure but keeping sector weights in balance. This rebalancing provides stability across market cycles. JEPQ is concentrated in the tech-heavy Nasdaq. With 109 holdings, it gives exposure to innovation and growth but lacks sector diversity. Roughly 50% or more of the fund's weight is in technology and communications. When tech booms, JEPQ does well. But when tech falls, the whole fund feels it. Winner in diversification. SCHD. Its multi-sector, rules-based structure provides a more resilient base, especially in turbulent markets. Category 3, dividend income. Let's get into what dividend investors care about most: income. SCHD currently yields around 3.9% and pays dividends quarterly. That might not sound impressive until you look at the growth. SCHD has delivered nearly 11.5% compound dividend growth annually over the last 5 years. Even better, it has increased its payout for 13 consecutive years. The result: if you'd invested $10,000 10 years ago, your dividend income today would be significantly higher than what you started with. This is the power of compounding. JEPQ, on the other hand, delivers an eye-popping 11.5% yield paid monthly. That's serious cash flow. But there's a catch. These monthly distributions fluctuate depending on market volatility and the premiums it collects from selling options. They're not guaranteed to grow and may even shrink in calmer markets. So if you're retired and need $1,000 per month right now, JEPQ can get you there. But if you're 35 and trying to build a future stream of income, SCHD's compounding power is likely the better choice. Winner for current income, JEPQ. Winner for income growth, SCHD. Category 4, risk and cost. SCHD has a beta of 0.86, meaning it's less volatile than the overall market. Its strategy focuses on stability and quality, and the low turnover from its annual rebalancing helps minimize trading costs. Plus, it comes with an ultra-low 0.06% expense ratio, just $6 per $10,000 invested. But SCHD isn't perfect. Its top 10 holdings make up over 40% of the fund, which adds some concentration risk. Also, its recent shift into energy means it could be more sensitive to oil price swings. JEPQ has a 0.35% expense ratio, higher due to active management and options trading. Its risk comes not only from its tech focus, but also from its strategy. Covered call funds cap your upside. In a strong bull market, you may underperform the NASDAQ or even QQQQ because you sold away the big gains in exchange for income. Plus, you're still exposed to downside risk if the market crashes. You keep the premium income, but the underlying stocks can fall significantly. Winner in risk management and cost, SCHD. Category 5, tax efficiency. This category is massively underrated. SCHD pays qualified dividends, which are taxed at the long-term capital gains rate, 0%, 15%, or 20% depending on your income. For example, if you make under $96,700 as a married couple in 2025, you pay zero tax on SCHD dividends. Even at higher income levels, the max is 20%. JEPQ's dividends are not qualified. Because they come from option premiums, they're taxed as ordinary income. That means rates up to 37%, depending on your tax bracket. If you're holding in a tax-advantaged account like a Roth IRA, this doesn't matter much. But in a taxable account, SCHD is much more tax efficient. You keep more of what you earn. Clear winner for tax efficiency. SCHD. Category 6. Performance SCHD has returned about 10.5% annually over the past decade, combining price appreciation and dividend. It's a strong performer that holds up in most market environments. That consistency is what long-term investors want. JEPQ has only been around since May 2022, but has returned around 13% annually so far. That's impressive, especially for an income-focused fund. But remember, the fund hasn't gone through a full market cycle. And in a roaring bull market, JEPQ will likely lag behind due to its capped upside. So, while JEPQ wins on short-term performance, SCHD wins on long-term reliability. Final verdict. Let's tally the score. SCHD wins. Diversification. Risk and cost. Tax efficiency and income growth, 4. JEPQ wins. Current income, short-term performance, 2. SCHD comes out ahead overall. But that doesn't mean JEPQ is a bad investment. It's all about what you need. If you're a retiree needing income today, JEPQ is a powerful tool. If you're a long-term investor seeking compounding dividend growth and stability, SCHD is hard to beat. In fact, the best approach might be a combination. Consider a 60-40th split. SCHD for long-term growth and tax efficiency, JEPQ for immediate income. This hybrid strategy gives you the best of both worlds. Whatever you choose, make sure it aligns with your goals, your time horizon, and your tolerance for risk. The dividend world has never offered more tools. Use them wisely. Disclosure: past performance is not indicative of future results. Always do your own research or consult with a financial advisor before making investment decisions. This content is for educational purposes only.